Introduction: global economic instability and the Bitcoin question. As the world grapples with unprecedented economic challenges, the conversation around Bitcoin and its potential as a global currency intensifies. In many circles, Bitcoin is no longer seen as just a speculative asset, but a viable alternative to traditional currencies. Some experts claim that Bitcoin could become the ultimate currency of the future, adopted by human society as a universal medium of exchange. However, with such prospects come dire predictions, as some believe this scenario could lead to catastrophic consequences. The notion of Bitcoin as the world's dominant currency elicits a wide range of reactions, from excitement to deep fear. Economists and financial analysts caution that such a shift could destabilize global markets, potentially leading to economic collapse. These conversations often take on an apocalyptic tone, as seen in discussions about China's current economic situation, where fears of financial collapse loom large. As China braces for an economic impact of historic proportions, understanding the underlying issues is crucial for investors, particularly those in the cryptocurrency space. China's economic situation, a brewing storm. China, one of the world's largest and most influential economies, is currently facing serious economic challenges. According to Sean Ryan, the managing director of China Market Research Group, China's economic situation has reached a critical point. Ryan has spent over 2 decades in China, and during that time, he has only been deeply concerned about the country's economic stability on 2 occasions. The first was during the COVID-19 pandemic, and the second is happening now in the wake of recent economic downturns. China's economy, once a powerhouse of growth and stability, is now showing signs of severe strain. In a recent interview, Ryan ranked the Chinese economy a dismal one on a scale of 1 to 10, where 10 represents a booming, healthy economy. This is particularly alarming given China's importance to global trade and finance. The economic downturn is characterized by a collapse in both business sentiment and consumer confidence, with retail sales growth stalling at a mere 2.2% in recent months. This slowdown has sent shockwaves through Chinese industries, leading to widespread concerns about the future of the country's economy. Key points of concern: high unemployment and workforce challenges. One of the most pressing issues facing China today is its skyrocketing youth unemployment rate, which has reached a staggering 18.8%. This figure is particularly concerning because young people are often seen as the drivers of economic innovation and growth. However, the current economic climate in China has created what many are calling a lost generation of Chinese youth who are unable to find work in a stagnant job market. China's rigid labor laws are exacerbating the situation, making it difficult for companies to lay off workers, even in the face of economic difficulties. If an employee has worked for a company for 9 years, the employer is required to provide 30 days notice and 9 months of severance pay before termination. As a result, instead of laying off workers outright, many companies have resorted to cutting salaries, clawing back bonuses from previous years, and demoting employees. This has created a toxic work environment across many industries, leading to a widespread sense of insecurity and fear among workers. The decline in business sentiment has had a cascading effect on the broader economy. Companies are hesitant to hire new employees, further contributing to the high unemployment rate. With both businesses and consumers unwilling to spend, economic growth has come to a grinding halt. The once vibrant Chinese economy now finds itself in a state of paralysis, with no clear path forward. In response to the worsening economic situation, the Chinese government has implemented a series of monetary policies aimed at stabilizing the market. While these measures have been described as a mini-stimulus, they have had a noticeable impact on Chinese equity markets, which have shown some signs of recovery in recent weeks. However, many experts believe that these efforts are insufficient to address the underlying issues plaguing the economy. The Chinese government faces a delicate balancing act as it tries to revive economic growth without triggering inflation or exacerbating existing financial risks. The current stimulus measures have focused on boosting liquidity and encouraging investment in key sectors of the economy, but the results have been mixed. While the stock market has seen a modest rebound, broader economic indicators, such as retail sales and industrial production, remain weak. There is growing pressure on the government to implement more aggressive fiscal stimulus measures. Sean Ryan has called for targeted, incremental stimulus programs that focus on specific sectors of the economy, such as infrastructure and technology. However, there is no consensus among policymakers on the best course of action. The fear is that without more substantial intervention, China's economic troubles could deepen, potentially triggering a broader financial crisis. Reasons for China's economic collapse: a perfect storm. Several factors have contributed to China's current economic woes, creating a perfect storm of challenges that have brought the country to the brink of crisis. The first major factor is the collapse of consumer confidence, which has been driven by a combination of external and internal forces. Externally, global trade tensions, particularly with the United States, have disrupted supply chains and weakened demand for Chinese exports. Internally, the lingering effects of the COVID-19 pandemic have left many consumers wary of spending, especially in discretionary sectors like retail and hospitality. Another key factor is China's rigid labor laws, which, as previously mentioned, have made it difficult for companies to adapt to changing economic conditions. These laws, while designed to protect workers, have had the unintended consequence of stifling business flexibility. Companies are reluctant to hire new employees because of the high costs associated with severance packages and other labor-related expenses. As a result, many businesses have opted to reduce their workforce through salary cuts and demotions rather than outright layoffs. The slowdown in business activity has also had a ripple effect on other sectors of the economy. For example, the real estate market, which has long been a cornerstone of China's economic growth, is showing signs of weakness. Property prices have stagnated, and construction activity has slowed, further contributing to the overall economic malaise. Economy comparison, debt and deficits on the rise. While China's economic troubles are certainly concerning, some experts argue that the situation in the United States may be even worse. Billionaire investor Paul Tudor Jones has been vocal about his concerns regarding the US economy, particularly the country's mounting debt levels. According to Jones, the US debt-to-GDP ratio has reached unsustainable levels, and the country is on a dangerous trajectory that could lead to a major financial crisis. In just 25 years, the US federal debt-to-GDP ratio has ballooned from around 40% to nearly 100%. This rapid increase in debt has raised alarm bells among economists, who warn that the US is headed toward a fiscal cliff. The Congressional Budget Office, CBO, projects that the debt-to-GDP ratio could reach 124% within the next decade, and if current trends continue, it could surpass 200% within 30 years. Such high levels of debt are historically associated with economic instability, as they limit the government's ability to respond to future crises and increase the risk of default. Jones points out that both political parties in the United States are contributing to the problem by making unrealistic promises about tax cuts and spending programs. These promises are often made during election campaigns, but once in office, politicians find it difficult to deliver without further increasing the deficit. This unsustainable fiscal policy, combined with growing budget deficits, could push the US economy toward a breaking point. Economic kayfabe, the illusion of stability. Paul Tudor Jones offers a unique analogy to describe the current state of the global economy. He compares it to WWE wrestling. In wrestling, there is a concept known as kayfabe, which refers to the unspoken agreement between performers and fans to suspend disbelief and accept the illusion that the matches are real. According to Jones, the global economy operates under a similar kind of kayfabe, where governments and central banks create the illusion of stability even though the underlying fundamentals are deeply flawed. This illusion is maintained through a combination of fiscal stimulus, monetary easing, and other policy tools that keep the economy afloat, even as debt levels rise and growth stagnates. However, Jones warns that this kayfabe cannot continue indefinitely. At some point, there will be a Minsky moment where the illusion collapses and the reality of the situation becomes impossible to ignore. When this happens, markets could experience a sharp correction, leading to widespread financial turmoil. Paul Tudor Jones's investment strategy, preparing for inflation. In light of these economic challenges, Paul Tudor Jones has adopted an investment strategy focused on inflation hedges. He believes that inflation is the most likely outcome of the current economic situation, as governments around the world try to inflate their way out of debt. Historically, inflation has been a common strategy for reducing debt levels, as it erodes the value of debt over time, making it easier for governments to repay. Jones is long on gold, Bitcoin, and commodities, which he believes will perform well in an inflationary environment. Gold has long been considered a safe haven asset during times of economic uncertainty, while Bitcoin is increasingly being seen as a store of value that can protect against inflation. Commodities, such as oil and agricultural products, are also likely to benefit from rising prices, making them an attractive investment in the current climate. Jones advises against holding fixed income assets, such as bonds, which tend to underperform during periods of inflation. Instead, he recommends a diversified portfolio that includes a mix of gold, Bitcoin, and commodities, which he believes offer the best protection against the coming economic storm. Conclusion: the road ahead. As the global economy teeters on the brink of crisis, it is more important than ever for investors to stay informed and prepared for what lies ahead. China's economic troubles are a clear warning sign that no country is immune to financial instability, and the situation in the United States suggests that the worst may be yet to come. While Bitcoin and other alternative investments offer a potential hedge against these risks, the future remains uncertain. Governments may indeed try to inflate their way out of debt, but this strategy carries its own risks. Inflation can spiral out of control, leading to a loss of confidence in fiat currencies and a potential collapse of the global financial system. Investors must remain vigilant, ready to adapt to a rapidly changing economic landscape. By diversifying their portfolios and focusing on assets that can withstand inflation, they can protect themselves from the worst-case scenario. This detailed analysis covers the key themes of China's economic instability, the United States debt problem, and Paul Tudor Jones's views on the future of the global economy.